This is SFNet Presents In the Know with host Barry Bobrow, sponsored by Hilco Global.
Well, welcome to the third podcast in the In the Know series. I'm your host, Barry Bobrow. My guest today is Maria Dikeos, head of loans contributions at Refinitiv. Today, Maria and I are going to have a very deep dive conversation about first half numbers for the leveraged debt market as well as the asset-based market. Well, welcome, Maria. It's great to see you. Before we dive in, I just want to let everybody know that I've known Maria. Actually, I think I first met you when you started up the asset-based league table, which I'm embarrassed to say is probably around 2003 or 4, somewhere in there. And you've been become a very good friend and also a great supporter and partner for the asset-based industry. So I really want to thank you for joining me on this new venture. And I'm really looking forward to the discussion of second quarter, first half 22 and outlook. So welcome.
My pleasure. Thank you for having me. Delighted to be here.
Great. So, hey, Maria, before we get into any numbers, and we've got lots of numbers today, talk a little bit about your role at Refinitiv, because it's actually quite a bit larger than just the little old asset-based industry.
Sure. So I head up global loans contributions at Refinitiv LPC, and which is a company owned by LSEG, the London Stock Exchange. And what I focus on is the collection and vetting of quality loan market data in the broadly syndicated large corporate middle market ABL community. So that's my mandate. And then I also focus a lot on analysis because it's something I love, and that's how I came across ABL and love.
We're glad you did. Yeah.
Yeah.
All right. So. Well, let's dive into some numbers here. Let's just do from 30,000 feet. Let's talk about leveraged loan and bond issuance year to date, and get into the macro on the loan market.
Sure. So obviously there were challenging market conditions this year across the credit spectrum. In the context of the leveraged loan market specifically, we saw more volatility for buy-side players, sell-side players, and that in turn sort of created unsettled pipelines. Returns were impacted, deal structures, and certainly ultimately the volumes. I think the best place to start is where we were at the beginning of the year. Coming into 2022, we had a lot of market momentum, which was sort of reminiscent to transactors of pre-COVID market conditions. And suddenly in 2Q, on the heels of certain inflation numbers being announced, Fed actions, there was growing recessionary fears, and the market became much more difficult to navigate. And across the credit spectrum, we saw volumes fall. As these charts indicate, loan and bond volumes declined precipitously. That was on the back of several outflows and just the absence of opportunistic financings. I don't know if you want to.
Well, anytime you see the secondary prices trade as low as they have, I guess the first comment, it's been an orderly market, which is actually very positive. It hasn't been a cathartic drop. It's been orderly, but anytime you see the pricing drop that much, it makes it much more difficult to price new primary and certainly to take underwriting risk on new primary. And so, not surprising. And the underlying driver is just uncertainty about. I mean, how do you value a company, let alone the debt that it supports, if you're not sure what inflation is, what supply chain's doing to it, what EBITDA is going to be, what the outlook looks like. So, huge fall in M&A volume drives uncertainty. It makes it harder to price, and then the end result is what you see in the chart there, just big dip in volume, and that's kind of, I think, where we ended.
Right, and I think it's important to kind of note, and I'm sure we'll talk about this. Liquidity, in contrast to what we saw, during the last credit crisis and all that, liquidity didn't dry up. It stayed in place. it was just the deployment of capital became a lot more selective.
That's
and,
right.
and so I think that's an important differentiation.
Yeah. Let's talk a little bit about, I don't want to get too lost in SOFR, but a lot of volume and a lot of market activity around SOFR. So let's talk about that. What are you seeing from a Refinitiv's perspective?
Sure. So what we saw was that the deal flow that did come to the market was heavily weighted towards refinancings and largely LIBOR replacement constructs. And I think that given the fact that the market as a whole was struggling, the fact that the lenders and borrowers generally coalesced around the steady adoption of term SOFR in an otherwise difficult quarter actually allowed for volumes to stay reasonable and steady and all of that. I think what these two charts show is, especially the one on the left, we saw SOFR perform as we would expect it to perform in anticipation of an ongoing rising rate environment. And that's good. It performed as we would expect. The market seemed to coalesce around a flat credit spread adjustment of 10 basis points. Yeah. So I think what we're looking at now and what we're thinking about right now is, will this flat rate stay in place? Because it certainly works if you're borrowing for 30 days, but it's less. Well,
another way to say it is, I mean, given the term structure of SOFR, if you have a flat rate, then if the borrower goes longer on their borrowing option, they're actually the lender is making a lower yield, and so it's interesting that the market's coalesced there. Although I would say, and we probably want to move on from it, most of the borrowings historically, a huge percentage, are at 30 days, so it's more of a hypothetical issue.
Yeah, but if I could ask you one question, and actually this is sure. The other one. Do you think that right now the market has likes the transparency that the credit spread adjustment offers? Mm-hmm. Do you think that a year from now, 2 years from now, the credit spread adjustment will be as relevant, or do you think that the market will sort of do away with it? And
I think ultimately it probably goes away, partly because issuers are going to keep pushing to eliminate it, and lenders are going to have to find a way to recoup their spread. Mm-hmm. and I think things will normalize. But right now, it's pretty transparent.
Yep.
No, interestingly, and the next slide here, I mean, and I'll take this one, but there's still a lot of LIBOR debt out there. Yeah. So the transition's been orderly, but still a lot to go. More LIBOR loans than there are SOFR loans so far, and that's kind of interesting. Like, what does the rest of the year bring? All that, your question, it'll play out over the next year, I'm sure.
Yeah.